guys done? Good evening, everyone. Today's topic is on quality control in audit. And what we're going to be dealing with are two standards on quality. SQC1, which is the quality control for firms that perform audits and reviews of historical financial information and other assurance and related service engagements. And SA220, which is the quality control for an audit of financial statements. So the first thing that we would like to analyze is what is the importance of quality control and audit quality in the work that we do. And the first question that comes to mind is that there is a certain amount of misunderstanding among auditors about the quality, about the importance of audit quality. So why is there a misunderstanding? A large number of auditors actually believe that they do audits for their clients who pay them. This conclusion is patently wrong because what auditors are doing is statutory audit, an audit required by statute or laws and regulations. And if those statutes, laws and regulations were not there, it is doubtful if many of our clients would ever employ chartered accountants to perform audits in the first place. The loyalty of auditors only to the auditee managements is therefore misplaced. Irrespective of the fact that audit fees are paid by those managements and audit committees, auditors must realize that they are responsible not to managements but to the stakeholders who read their audited financial statements and reports and take important financial and business decisions based on what the auditors have reported. Who are these stakeholders? They are the lenders, creditors, business associates, tax authorities, those charged with governance, employees, shareholders, and anyone whose resources would or could be affected by the financial health and performance of the auditee. The next question is, how does not doing a quality audit affect an auditor? While an auditor may have a contractual relationship with the auditee to perform audit in the form of an engagement letter, an auditor must remember that the contract contains an implied obligation that the audit would be planned and performed in accordance with the applicable laws, regulations, and relevant professional standards. In the auditor's report that he issues to the auditee, the auditor makes a written and signed assertion that he has performed the audit in accordance with those laws, regulations, and standards. The authorities who administer those laws, regulations, and standards have mechanisms to ensure that the auditor performed their duty as they are expected to. We therefore have regulators such as NEFRA, ICAI, SEBI, RBI, IRDA, etc., who exercise jurisdiction over auditors and their work. Of late, the regulatory environment for the auditing profession in India has become so onerous that it would not be wrong to say that the profession is overregulated. Besides, laws such as the Companies Act 2013 have prescribed heavy penalties, including imprisonment for auditors, and also their firms found to be delinquent. There have been cases where SEBI has even tried to ban a reputed firm from performing audits. This is because society's expectation from auditors is extremely high, and governments are keen to protect those expectations at any cost. Auditors of both public and private companies must realize that they are answerable not to their clients, but to society at large, and that therefore their audits must possess the quality that society expects. Can a small audit firm get away with a lower quality standard than a larger firm? This is like asking if a small medical practitioner can get away with allowing a patient to die of complications while a more reputed or bigger medical practitioner cannot. When a set of financial statements and an auditor's report are signed by a chartered accountant, the size of his firm has no bearing on the risk, responsibility, and liability that it carries. Do quality standards apply equally to small and large firms? SQC1 and SA220 are standards on quality control of audit firms and of the auditing process that they carry out. These standards do allow an auditing firm to frame its quality control policies and procedures so that they are sufficiently comprehensive and are suitably designed in relation to the firm's size, the nature and complexity of the firm's practice, and appropriate cost-benefit considerations. What does this mean? This means, for example, that a small firm with non-complex clients need not have as elaborate an independence testing and monitoring mechanism as a large firm would. But it does not mean that a small firm may have no independence policy and procedures at all. This means, for example, that a small firm may have a less comprehensive level of audit documentation than a large firm would. But it does not mean that its audit files contain little or no evidence of the work done by its engagement teams and reviewed by its signing partner. The scale of quality control policies and procedures and their implementation in smaller firms could be less in terms of quantity if possible, but not in terms of quality. And the scaling down decision should be taken by the smaller firm after considering all aspects of audit risk, because regulatory risk is not any lower for small firms. What is audit quality? Audit quality encompasses the key elements that create an environment which maximizes the likelihood that quality audits are performed on a consistent basis. SQC1 explains these elements and requires audit firms to establish policies and procedures of quality control that would ensure that an environment is created within audit firms that is conducive to high quality audits. SQC1 does not deal with just an individual auditor's responsibility for quality. It deals with the responsibility of the whole audit firm, particularly of the managing partner, CEO, or proprietor who heads that firm. SA220, on the other hand, focuses responsibility for audit quality on the engagement partner. So between the two standards, the firm's managing partner would be responsible for setting up quality controls at the firm level that all audit partners and the firm have to follow, and the engagement partner would be responsible for implementing those quality controls on his specific audit engagement. What are the characteristics to be possessed by an engagement team that would achieve a quality audit? A quality audit, according to IFAC, the International Federation of Accountants, is likely to be achieved by an engagement team that exhibited appropriate values, ethics, and attitudes, was sufficiently knowledgeable, skilled, and experienced, and had the sufficient time allocated to perform the audit work, applied a rigorous audit process and quality control procedures that complied with law, regulation, and applicable standards, provided useful and timely reports, and interacted appropriately with the relevant stakeholders. Who and what is responsible for the performance of quality audits and the audit quality? The responsibility for performing quality audits rests with auditors. However, audit quality is best achieved in an environment where there is support from and appropriate interactions among participants in a financial reporting supply chain. This supply chain includes the engagement partner, the engagement team, the audit firm, the auditee, and the audit regulators. Let's now start and actually get into SQC1. What is the nature of quality controls? Why is an audit firm required to design, implement, and effectively operate quality controls? When we as auditors perform an audit, what we first look for is whether that entity has sufficient appropriate internal controls to prevent and detect any misstatements in the accounts. If the internal controls of the entity are sound, we get an inherent assurance about the quality of the entity's financial statements. Likewise, when the internal controls of an audit firm are sound, the stakeholders whom we serve get an assurance that the audit firm will perform quality audit. In our auditor's report, we make certain assertions about the work that we have done in performing the audit. How can we make those assertions unless we have a system in place to make sure that we've actually done what we say we have done? That system would include quality controls. Quality controls include policies and the procedures to implement and monitor those policies. What assurance do quality controls provide to an audit firm? Quality controls provide an audit firm with a reasonable assurance that number one, the firm and its personnel comply with professional standards and regulatory and legal requirements, and two, that the reports issued by the firm or its partners are appropriate in the circumstances. So SQC1 has got 6 elements. So what are these 6 elements around which an audit firm should design its quality control policies and procedures? These 6 elements are 1. Leadership responsibilities for quality within the firm, ethical requirements, acceptance and continuance of client relationships and individual engagements, human resources, engagement performance, and lastly, monitoring. Why does SQC1 require that an audit firm's quality control policies and procedures must be 1. Documented and 2. Communicated? As mentioned before, we no longer perform audits in a vacuum. Our professional actions are subject to outside scrutiny, particularly by regulators. Regulatory inspections are now a part and parcel of audit practice. It started with ICAI's peer review and was then enhanced by reviews by the Quality Review Board. For banking companies, RBI has always conducted separate audits and inspections. These are routine inspections. However, when something goes wrong, such as fraud in an auditee organization, a whole new set of inspections happen. Such inspections could be done by NEFRA, the Enforcement Directorate, the Serious Fraud Investigation Office, the Economic Offences Wing of the CID, SEBI, RBI, IRDA, etc. The disciplinary jurisdiction of ICAI has now largely been liquidated and appropriated by NFRA, which is a government body and not a body comprising of fellow chartered accountants. This second set of investigations is far more serious than the first because they could implicate an auditor and his audit firm in a criminal case in addition to professional liability. It is crucial now for auditors to create evidence of the work that they do so that they can defend themselves against accusations of professional negligence or worse, collusion in a fraud. If one reads the report of NEFRA against an audit firm in a recent matter of investigation into a fraud, the regulator has gone with a fine-tooth comb to challenge the audit firm on not only adherence to the requirements of SQC1, but has even challenged its interpretation of certain terms mentioned in the standards. By doing so, the regulator is trying to establish a case of collusion in the fraud against the audit partner and the audit members of his audit team. A very large part of the NEFRA report revolves around accusations of not complying with SQC1. Such reports eventually end up in courts of law, sometimes going all the way up to the Supreme Court, where audit firm has to defend itself by proving the regulator wrong. Under such a scenario, the auditor has to provide evidence in his defense. Unless he has created such evidence in the first place, there is no way that he can defend himself. The standard itself requires him to create this evidence by first documenting the quality control policies and procedures that he has established, and then to document how he communicated those policies and procedures to the engagement team and other personnel within the firm so that they are aware of those policies and procedures. And finally, to document how he has monitored the effective operation of those policies and procedures. Oral evidence where an auditor says that he followed a particular quality control or other procedure will not stand up in a court of law when the standards specifically require him to create documentary evidence. The auditor may have established quality control policies and procedures, but if he cannot prove that he communicated them to those who were required to follow them, those policies and procedures are of no value at all. Such communication must, 1, describe the policies and their objectives, 2, emphasize that each individual has a personal responsibility for quality and is expected to comply with the policies, and 3, explain that the firm encourages its personnel to communicate their views and concerns on quality control matters. What are the responsibilities of the managing partner, CEO, or proprietor, that is the leadership of the firm, with regard to quality control within the audit firm? Any system of quality control depends for its success on the importance and seriousness with which the leadership considers it. If the tone at the top is lax or is allowed to be compromised in certain cases, personnel down the line cannot make that system work. The leadership has to promote an internal culture of quality within the firm. He has to be a role model in upholding that culture by personal example. He has to demonstrate, or in other words, evidence, his leadership in this regard by clear, consistent, and frequent actions and messages to those below, emphasizing the importance and seriousness of complying with the firm's quality control policies and procedures. Such messages could be in the nature of training seminars, mission statements, newsletters, etc. But just sending messages is not enough. Compliance with quality controls should be tied in to the partner and staff appraisal process so that those who follow them may be rewarded and those who do not are punished. Performance evaluation, compensation, promotions of senior personnel should be designed to demonstrate the firm's commitment to quality. It should make amply clear to the whole firm that as far as audit is concerned, commercial considerations are not allowed to override quality of the work performed or the report issued. There will be situations where an audit exceeds the number of man-hours or time cost planned for it. Irrespective of that, the message sent by the leadership must be that there should be no compromise in audit quality, and sufficient resources are devoted to develop, document, and support the firm's quality control procedures. While it's understandable that an audit firm's leader may not personally have the time to oversee all aspects of the and responsibilities under SQC1, the standard permits him to depute a suitable person, say another senior audit partner, to perform his role. However, the leader must ensure that the appointed quality controller is sufficiently high in the firm's hierarchy to be able to command the required respect and ensure compliance with SQC1 by all other partners and personnel of the firm. We now come to the second aspect, ethical requirements. So what are ethical requirements? Ethical requirements under SQC1 comprise of two parts, ethics and auditor independence. Each of these is very subjective, and therefore the firm leadership needs to set the tone at the top to ensure that everyone in the firm understands the spirit and culture that comprises ethics and independence. Far too often we've seen instances where compliance with ethics and independence, quality controls, is actually lip service, and compromises are made for expediency or financial gain. It should be remembered that the only reason we are auditors is because we are trusted to perform an impartial scrutiny of the books and records of entities that we audit, and report honestly and without bias. The moment that trust is breached, the society will no longer want to use our services. So upholding the highest level of ethics and independence is vital to the survival of the profession and cannot be taken lightly by firm leadership. Which components are addressed within the Code of Ethics? As we all know, ICAI has a prescribed Code of Ethics that we must follow. This code encompasses 5 fundamental principles that an auditor must possess, exhibit, and practice at all times. These are integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Integrity means to be straightforward and honest in all professional and business relationships. Objectivity means not to compromise professional or business judgments because of bias or conflicts of interest or undue influence of others. Professional competence and due care is to attain and maintain professional knowledge and skills at the level required to ensure that the client receives competent professional service, and 2. Act diligently and in accordance with applicable technical and professional standards. Confidentiality means to respect the confidentiality of information acquired during the course of professional work. And professional behavior means to comply with relevant laws and regulations and avoid any conduct that the auditor knows or should know might discredit his profession. Battery is running low. So what is auditor independence? Auditor independence is of two types: independence of mind and independence in appearance. Independence of mind means a state of mind that reaches a conclusion without being affected by influences that compromise professional judgment, thereby allowing an individual to act with integrity and exercise objectivity and professional skepticism. Independence in appearance means the avoidance of facts and circumstances that are so significant that a reasonable and informed third party would likely conclude that the auditor's integrity, objectivity, or professional skepticism has been compromised. SQC1 expects a, an approach which we call a threats and safeguards approach. Generally in SQC1, we follow what we call this threats and safeguards approach to auditor independence, which means that the audit firm evaluates situations that could threaten its independence and professionals, and where it finds that the threat is significantly potential, it adopts safeguards to ensure that the threats are effectively reduced to an acceptable level. Such safeguards are the quality controls that a firm installs. 5 such situations are common to most firms. First is the self-interest threat. When an auditor could benefit from a financial interest, for example, an investment, or other self-interest conflict, for example, employment or business relationship of a close relative with his client. The next threat is called the self-review threat. Self-review threat is when the auditor audits work done by himself or by others from his own firm, or when a partner or professional with authority in the firm was previously an employee or officer of the client and therefore in a position to exert influence over the audit. Advocacy threat, number 3, when in reality or in perception, an auditor promotes his client's position or opinion to the point that objectivity may be compromised. The fourth threat is familiarity threat, when by virtue of a close relationship with his client or client's personnel, an auditor becomes too sympathetic to the interest of his client or its personnel. And lastly, the intimidation threat, when an auditor may be discouraged from acting objectively and exercising professional skepticism by threats which are actual or perceived from client personnel, including the threat to move the engagement to another firm. What quality controls could a firm install to ensure that its personnel, partners, and professionals adhere to ethical requirements? The quality controls to ensure that its personnel adhere to ethical requirements could be: 1, that the leadership could designate a senior partner as the ethics and independence partner. This partner should be empowered to perform checks and ensure that all firm personnel follow the firm's documented ethics and independence policy. Any breaches should be promptly reported to leadership, which must immediately take disciplinary action. Number 3, a system should be put in place to identify all services that are being provided to a client and to evaluate if any of them are independence impairing. Number 4, regular trainings for all personnel on independence and ethics should be conducted. What are the quality controls to communicate the independence requirements? Ensuring that all personnel have read and understood the firm's ethics and independence policies, and preparing, maintaining up to date, and making available a list of entities which are audit and attest clients with whom the firm or its personnel are prohibited from entering into financial or business relationships. What quality controls could a firm install to identify and evaluate possible threats to independence? Some of them are requiring the engagement partner to evaluate whether there are any independence issues pertaining to the engagement before he takes it up. Providing training to personnel about threats to independence and how to cite and respond to a threat. Thirdly, requiring personnel to immediately report circumstances and relationships that might create threats to independence. 4. Establishing criteria to safeguards to be taken if a threat is seen. For example, if a client is pressurizing the engagement team to take a particular position, or if the same senior personnel have been used on the audit for more than 5 years. Creating a mechanism for promptly communicating identified breaches of independence to the engagement partner, the ethics and independence partner, and leadership. And finally, documenting the threats to independence applied. To take action, what are the quality controls to take action if the threats to independence cannot be reduced to an acceptable level? So first thing that we do is we determine what are the threats to independence, evaluate them, and then what action do we take when those threats of independence cannot be reduced to an acceptable level by safeguards. Establishing a process of internal consultation and consultation with outside parties or legal counsel if necessary. And secondly, withdrawing from the engagement if need be and if it is legally possible. So if there is an independence impairing situation and we feel that we cannot reduce that threat of independence impairment, we may need to actually exit from the engagement. What quality control should a firm install to obtain written confirmations from its partners and professionals? Obtaining written representations from all personnel upon hire and then annually to state that they have read and understood the firm's ethics and independence policies and have consistently complied with those policies since the date of the last representation, and if not, to state exceptions. Then, reviewing the independence representations and resolving the exceptions. And finally, requiring the engagement partner to document independence compliance with reference to the engagement in the audit work papers. What quality controls should a firm install to confirm the independence of another firm that performs part of an engagement? This is particularly relevant in case of group audits, where there is one auditor who is auditing the parent company and smaller different audit firms auditing the component audits. The quality controls there would be to obtain an independence declaration from the other firm as frequently as required, and requiring that such declaration is kept in the audit work papers. Now, for many firms who have not got a regularized or a standardized quality control process around independence, we have a book, an ICI publication, which is called Implementation Guide to SQC1. In that guide, there are certain annexures or illustrative examples of certain templates. And a sample of the illustrative annual firm personnel independence confirmation is provided. So I would strongly urge that those who are serious about having quality control within their firms purchase this implementation guide to SQC1, because that will actually walk them through the process of installing these controls, and also use the various templates which are available and tailor them to their own requirements, so that you don't have to reinvent the wheel as such. So this is the first of the two templates relating to independence. So this is the annual firm personnel independence confirmation. This confirmation has to be obtained from all professionals in the firm, partners and professionals in the firm annually and kept on record. The second is illustrative independence policies. Now, most of the firms, the very large firms, have elaborate independence policies. Smaller firms may or may not have such independence policies. So for those who do not have those policies, here is a template which they can either accept it as it is or tailor it to suit their own firm's requirements and put this in place as the firm's independence policies. Then it is for the firm to monitor implementation of these policies. So with this, we have completed two of the elements of SQC1. We now come to the third element, which is acceptance or continuance of clients and engagements. So why is the process of acceptance and continuance of a client relationship or of an engagement so important for an auditor? It is a proverb that a man is known by the company he keeps. An auditor works on people's trusts, and therefore his reputation often precedes him. His reputation for honesty and integrity can get shadowed if the clients that he associates with and the kind of engagements that he undertakes are not perceived in the marketplace to be straight. Auditors should therefore take care in choosing their clients and engagements. Apart from this overall reputational reason, the auditing process requires close interaction between the auditor and the client personnel, where an auditor seeks information and explanations for the transactions that he audits. An auditor also seeks written representations from the client on various matters. He evaluates the information that he gathers with sufficient appropriate audit evidence. It is therefore very important for the auditor to ensure that the information, explanations, representations, and evidence provided to him are truthful, unbiased, and genuine, because he relies on them in forming his judgment. If the client management and staff lack integrity, it would not be possible for the auditor to rely on their assertions or evidence, and he cannot perform the audit. Thirdly, the engagement partner should ensure that he and his team have the knowledge, expertise, and competency to undertake the engagement on hand. For example, if an auditor has no knowledge or experience of auditing entities using complex derivatives, he should not undertake an engagement where the client has significant exposure to derivatives. Similarly, if the engagement is spread over a number of geographies and its scale requires the use of a large number of assistants, but the auditor does not have that much professional staff, he should not accept such engagement. Likewise, if the engagement has a delivery deadline that the auditor believes will be difficult or impossible for him to meet, he should not accept such engagement. This may be particularly true of some of the bank branch audits, where the time given is so short that the auditor cannot reasonably plan and perform a proper audit. Fourthly, there may be cases where independence requirements cannot be met by the auditor because of a self-interest, self-review, intimidation, or other threat, where safeguards cannot reasonably reduce that threat to an acceptably low level. He would then need to step away from such an audit engagement. In case of the above issues, any of the above issues is identified and the auditor nevertheless decides to accept the client or engagement or continue it, he should document in the audit work papers the reasons why he is doing so and how he has taken care of those concerns. We now come to a very interesting point, which is management integrity. Integrity is a human quality. The practice of being honest and showing a consistent and uncompromising adherence to strong moral and ethical principles and values. In evaluating it, what is most important to understand is that integrity of management must be towards all stakeholders: employees, customers, suppliers, shareholders, government, and the community at large, and of course, auditors. A management that demonstrates selective integrity, for example, saying that it is honest with auditors but would like to cheat on tax payment to the government, cannot be said to have integrity at all. If today it cheats the government on tax, tomorrow it could just as easily give false information to auditors if it suits so, if doing so suits its purpose. Why is management integrity critical to an auditor? If an auditor cannot trust the honesty of his client, he cannot trust the genuineness of evidence that such a client produces before him, or of the representations that he makes in response to his queries. He cannot trust the uprightness of the motivations that drive a client in making accounting estimates or in recognizing proper revenue. As such, the auditor would have to suspect the truth and fairness of the financial statements produced before him. Under these circumstances, an auditor should not take the risk of performing the engagement and should resign. Why do managements compromise their integrity? There could be many reasons that drive managements to compromise their integrity. Some of them are a compulsive growth mania. They want to grow their business every quarter and every year by hook or crook. If the business does not do well, they will cook the books to show that it has grown. Another reason is raising capital. Many businesses need regular infusion of capital. To raise capital from markets, they need to show strong balance sheets and outstanding performance. Third reason, compensation linked to stock performance. When senior management's remuneration is linked to the stock price, they will try to boost the stock price by any means possible. Number 4, ESOPs. When senior management hold ESOPs in their companies, a high stock price is in their interest too. Number 5, when one company wants to acquire another and pay for it by making an equity swap rather than a cash deal, then it needs a high market price for its stock. And lastly, high market cap of their companies increases the social reputation of entrepreneurs as a measure of their wealth. When does management integrity typically get compromised? When quality controls are weak, it gives management the opportunity to do wrong. For example, if there is a weak board of directors which just accepts and does not adequately challenge management on issues like accounting policy, related party transactions, senior management compensation, etc. Where decision making is in the hands of just one or two individuals and checks and balances are absent. Third, when auditors lack objectivity, independence, and due diligence and fail to challenge management, or worse, knowingly acquiesce in what the management wants to do. What kind of quality controls can a firm establish for acceptance and continuance? Some examples. All firm personnel should be informed and aware of the firm's policies of acceptance and continuance of client relationships and engagements. Not only just the managing partner, but all firm personnel. Number two, information should be obtained and considered regarding scope of services expected and what the management expects, identity and attitude of the client's owners, promoters, key management personnel, related parties, those charged with governance, internet searches on the client and its sister concerns or associated companies and firms, third-party inquiries from marketplace, understanding of operations and business practices of the client, nature of the industry and what are the risks associated with it, aggressive interpretation of accounting standards, if any, aggressive audit fee negotiations, aggressive timelines and scoping limitations on audit work, indications of client indulging in money laundering, other criminal activities, or dealing in black money. Communication with predecessor auditor. Background checks of the business and of the top functionaries. Checking for conflicts in rendering desired service and independence. Evaluating whether the engagement can be completed with professional competence within the resources and capabilities available. Cementing the understanding of the engagement by means of a written engagement letter. The firm establishes procedures for withdrawal from engagement and client relationships where the need arises. Documenting all issues relating to acceptance and continuance. So just as in the case of independence and ethics, we have another illustrative client engagement, acceptance, and continuance form in the implementation guide to SQC1. So when you fill up this form, it will highlight features that one should actually observe. When accepting or continuing a client relationship or engagement. We now move on to the next element of SQC1, which is human resources. So the question is, why is talent or human resources so important for an audit firm, and why are quality controls required for it? An audit firm's primary asset and tools of trade are its people. It is the quality of human talent of a firm that distinguishes it in the marketplace from other firms and is the backbone of its professional reputation. An audit firm should therefore be extremely careful about hiring and nurturing the best talent it can find and afford. Dealing with talent is never an easy job because it involves human sensitivities at every level. A good audit firm makes a large investment in developing its human resources and needs to plan for it. Quality controls are required because a standard, transparent procedure in dealing with partners and professionals, including their career advancement and compensation, should be established in order to avoid conflicts and unhappiness. Besides, rules must be laid down for ensuring that partners and professionals maintain their capabilities and competencies and perform their tasks as per the firm's policies. What kind of quality controls may a firm establish to ensure that its partners and professionals have the required capabilities and competencies? Some of these quality controls are as under. The firm designates an individual to be in charge of the HR function and empowers him adequately. It evaluates its personnel needs, the attributes, achievements, and experience desired at various levels, and develops criteria for interviewing and hiring people. The firm specifies the skills and competencies required of an engagement partner and the personnel who will assist him. The firm leadership assigns responsibility for each engagement to an appropriately competent engagement partner having the necessary skills, time, authority, and experience in managing similar audits. It communicates the identity and role of the engagement partner to the client and monitors the partner's workload to ensure that he is able to discharge his responsibilities adequately. The firm leadership assigns personnel to the engagement team based on criteria like the type, size, and complexity of the engagement, specialized experience and expertise required, availability of personnel, timelines to be observed, continuity and rotation of personnel, situations involving independence considerations. The firm assigns responsibility for the function of learning to a senior individual. A learning calendar of personnel at various levels is laid down annually with flexibility to change it to meet additional or changing requirements. Internal and external training programs, including e-learning, are scheduled, held, and the attendance is strictly monitored. The firm leadership and HR partner determine the compensation levels of partners and professionals, laying out and implementing the process of evaluation, including self-evaluation and feedback, etc. The HR partner lays down the procedures for regular counseling of partners and professionals so that they become aware of their strengths and weaknesses and follow the laid down roadmap for improvement or achieving excellence. We now come to the second last element of SQC1, which is engagement performance. And of the 6 elements, why is engagement performance considered to be the most prominent is the question. The job of an audit firm is to perform audits, reviews, and attest certain certificates and reports that provide assurance to the stakeholders. While the other elements such as leadership responsibilities, ethical requirements, acceptance and continuance of clients and engagements, human resources, and monitoring are important, they basically play a supporting role to uphold the integrity of the firm's audits and attestations. But the actual task of performing the audits and attestations is covered by the element of engagement performance, thus making this element the most prominent. What are the steps in the process of engagement performance from a quality control viewpoint? SQC1 has broadly categorized and established the establishment of quality controls for engagement performance as under. First is proper planning of engagements. 2, proper performance of engagements. 3, proper review of engagement work. 4, proper file assembly of work papers. 5, proper maintenance of confidentiality, safe custody, etc. of work papers. 6, proper retention of work papers. 7, proper and timely consultation where required. Number 8, proper resolution of differences of opinion. And lastly, proper establishment of criteria, performance, and documentation of engagement quality control review, that is EQCR. So these are the various heads under which engagement performance quality controls are categorized. So we come to the first of these, which is engagement planning. Why is engagement planning given so much importance in the standards on auditing? Planning of audits and other attest engagements as a component of the total process is generally not given the kind of gravity that is needed. Many of the smaller firms, particularly those that have not yet embraced performing audits as per SAs and QCs, are generally disinclined towards audit documentation, actually considering spending time on audit planning as a waste of time and money. This wrong notion needs to be corrected as soon as possible, given that the world over, as well as in the larger audit firms in India, at least 40% of the total engagement hours are spent in planning engagements. Why is engagement planning crucial? We no longer live in an era where we performed 100% audit of all events and transactions. When we perform test check, what we do is we leave out testing a major part of the transactions while focusing in depth only on a small sample. And based on the results of auditing that small sample, we form a conclusion about the entire universe of transactions, including transactions that we have not examined. This is obviously fraught with the danger that we might omit examining certain sensitive or fraud-prone transactions, and as a result, our audit opinion could be false, exposing the engagement partner and the engagement team and the entire audit firm to significant professional risk. What the audit planning process does is that it enables us to understand the entity and its environment to a level where we are able to identify risks and their magnitude, plan appropriate audit procedures to address and mitigate those risks by putting the right people and the right audit processes in place, select the right number of samples and estimates to be audited in a scientific way, periodically evaluate the results of the outcome of these measures and making changes as required, and then to monitor compliance with the audit plan. What quality controls does a firm need to put in place to ensure that engagement planning meets professional, regulatory, and the firm's requirements? To enable a proper and standardized audit planning process across the firm, every firm needs to adopt certain practice aids. Practice aids are standard templates, checklists, etc., that ensure that all required aspects of a task are comprehensively covered and none of them left out. Practice aids also enable the engagement team to notice matters that require attention and to address them as per the procedures laid down. For audit planning, a practice aid in the nature of a detailed audit planning memorandum is normally used. This enables the engagement partner to assign responsibilities to appropriate personnel, develop and update background information on the client and the engagement, understand the entity and its environment from the viewpoint of assessing the various risks to which it might be exposed, evaluate the location and magnitude of such risks, and draw up an intelligent plan of audit procedures to be applied so that the risky areas get maximum auditor attention, while the rest risky areas also get covered, but with lesser focus. This also requires scientific sampling and analytical methodologies to be employed. Consider the risk of fraud and respond to those risks. To budget time in a way that enables the engagement team to perform the engagement in accordance with professional standards, laws and regulations, and the firm's quality control policies and procedures. Once again, in the implementation guide to SQC1, a sample of illustrative engagement planning memorandum for a firm is provided. This is a very detailed document, and if you try to fill it up for a client, it should be sufficient for you to do planning in a very structured manner. So the next thing is, after planning, what quality control should be established by a firm for engagement performance, supervision, documentation, reporting, and communication? These are vital quality controls that include ensuring that all auditing standards relevant to the engagement, including standards on risk assessment and fraud, are clearly understood by the engagement team and are duly complied with. Laying down clear-cut responsibilities on how the work performed by junior team members should be supervised by seniors, providing detailed briefing to professionals on the job as to the nature of risks that they are likely to deal with during the work, and how the engagement partner has planned to address those risks, and ensuring that the personnel entrusted with doing particular tasks are well trained and experienced. Ensuring that a written audit program is followed and monitored for all engagements. Requiring that across the firm there is consistency in the way audits are performed by different engagement teams. This is achieved by the firm having in place standard written manuals, software tools, checklists, templates, models, and other forms of standardized documentation and industry or matter specific guidance material. Ensuring that a suitable audit summary memorandum is documented and filed in the work papers to provide a history of the planned risks, including fraud risks, by what audit processes those risks were mitigated, conclusions on controls and substantive testing, and whether the extent and quality of the audit supports the audit opinion. Such audit summary memorandum is supported by file notes or memoranda dealing with the audit of the more complex and contentious areas of audit. Addressing new risks and significant issues that emerge during the course of the audit, and updating the audit plan accordingly to address these. Adhering to the firm's guidelines for the form and contents of documentation of work performed and conclusions reached. This would be a standardized forms, checklists, and questionnaires used in performing the engagement. Requiring the engagement documentation in accordance with professional standards, applicable regulatory requirements, and firm's policies. How does the firm follow a policy of having the work performed by engagement teams duly reviewed? It is a fact that engagement teams in audit firms are composed of several categories of professionals, from the senior-most engagement partner to the newest article clerk. Their levels of knowledge and experience vastly differ. And yet, that team works on a singular project and comes up with an audit opinion. It is very vital that in such circumstances, there is sufficient hand-holding of the junior members of the team by the seniors, who must guide them and make sure that they do not make mistakes that could derail the audit. It is also very important that reviews are performed on a timely basis throughout the course of the audit, so that there is no scramble to complete them just before the scheduled sign-off date. When that happens, as it sometimes does in large audit engagements, the quality of review, which is a key audit control, quality control, could get compromised. Some of the ways in which the firms do this are: 1. Ensuring that all those who have reviewing responsibility have the appropriate experience, knowledge of accounting and auditing standards, competency, and responsibility. ensuring that in the work papers of every engagement, there is ample evidence of reviews having been performed of the work done, conclusions reached, financial statements analyzed, and reports issued, ensuring that documentation is reviewed to determine whether sufficient work has been performed as per the audit plan in accordance with professional standards and regulatory and legal requirements, whether significant findings and issues were raised for further consideration by the engagement partner, whether appropriate consultations have taken place and the process and resulting conclusions have been documented and implemented, whether the nature, timing, and extent of work performed are appropriate and do not need revision, for example, when new risks are identified, when controls are seen to be failing, or when there were unexpected findings or observations during the course of your audit work. Whether the quality and quantity of work performed and the results of testing support the conclusions reached, whether the evidence obtained in support of financial statement assertions, including disclosures, is sufficient and appropriate to support the audit opinion expressed in the report, and whether the objectives of the audit procedures have been achieved. How does a firm maintain the confidentiality, safe custody, integrity, accessibility, retainability, and retrievability of engagement documentation? Documentation prepared and filed by the engagement team in audit file may contain very sensitive details of the client's financial affairs. In several major listed public companies, very strict confidentiality is maintained about such information even during the course of the audit, so that information given to auditors is strictly controlled. Certain information is provided only to the engagement partner and not even to senior managers or assistants, even to the company's or even to the company's own officers and staff. Some of this information could be very price sensitive, and any leak of such information before it is officially announced by the company could shake the stock markets or result in insider trading in the company's stocks. An audit firm, therefore, has a very big responsibility in maintaining confidentiality of client information that it obtains during the course of its professional work, and also for preserving it in safe custody, such that it cannot be tampered with after the audit is done and can only be retrieved if there is a good and valid need for it to be retrieved. The risk of audit documentation leaking out is hugely increased by the widespread use of electronic means where a document could be transmitted even across continents within a fraction of a second. It therefore needs to establish and maintain strict and robust quality controls for this. Controls should be set up to clearly define who is responsible for preparation and review of documentation. To protect the integrity of documentation, when such documentation is shared among engagement team members, for example, a reviewer should not have the ability to make alterations to documentation prepared by a junior, and if a change is required to be made, the preparer himself must make it. To permit access to documentation only to authorized persons. To control at every stage both hard copy and electronic documentation, installing safeguards like passwords and encryption for electronic documents and physical controls for paper documents. To put in place adequate backup mechanisms to safeguard against accidental deletion or corruption of electronic files. To have a strict policy to prevent any changes being made to engagement documentation once the work paper file is assembled, completed, and archived, and a policy for retrieval of archived files where required and authorized. To have a policy that does not compromise client confidentiality while sharing work papers with others from network firms. For example, where one network firm performs the audit of an entity for which another network firm may audit a component in case of a group audit, or even when a regulator requires the auditor to furnish certain documentation relating to the audit he performed for a client. To ensure that when electronic technology gets changed, the electronically saved documents are suitably upgraded to the new technology under strict control. What policy and procedures should a firm establish for consultation? Various contentious issues and difficulties may arise during an audit where there may be a doubt or multiple views within the engagement team, such as on the application or interpretation of a standard law or regulation, or on a matter of ethics or independence or procedure. In all such cases, it is obligatory for the engagement partner to seek consultation from others who have appropriate technical knowledge, authority, or experience. Such consultation is generally held within the firm itself, except when the firm lacks people with the domain knowledge and experience required to provide such consultation. Mere seniority of a partner or his position within the firm does not qualify him to be the one to be consulted. Where a firm does not have the right persons or persons within the firm to provide consultation, it uses advisory services provided by other firms, professionals, or regulatory bodies, or commercial organizations that provide and are determined to be capable of providing such service. Consultation is a formal written process that must be duly carried out as per the firm's policies and procedures and documented in the work papers. It is not like one person orally asking a question to another and acting on the guidance obtained. Consultation safeguards an auditor by establishing and providing evidence that he acted with due care in forming his judgment on contentious or ambiguous matters. All firms' personnel should be well aware of the firm's policy and practices on consultation. The engagement team should prepare a document, generally called a consultation memo, laying out the exact issue on which consultation is sought and the full history, pros and cons that give rise to the question or ambiguity, including references to and extracts from accounting and auditing literature. This is so that the person consulted has all the information available before him. The engagement team should be available to answer all the queries raised and provide detailed explanations as required. The person consulted should be required to provide a reasoned, written response to the matter under consultation. This response should be evaluated by the engagement partner and his team, and a decision taken on implementation of the consultation findings. In case the engagement partner differs in opinion with the consultation, which should indeed be a rare event, he would need to record the reasons for not agreeing and for taking a different stand. In such cases, he takes full responsibility for his actions. What policy should a firm have for resolving differences of opinion? When several professionals are working on an engagement, some junior and some senior, it is quite possible that one may not agree with the opinion of another on an issue. It would be unethical and wrong for a senior person to impose his opinion on a junior just because of his seniority. Differences of opinion within an engagement team should generally be resolved by the engagement and EQCR partners, and where necessary, by reference to the firm's managing partner. Like in the case of consultation, the conclusions reached should be documented and signed off by the persons concerned. If a member of the engagement team remains unconvinced, continues to hold his opinion, and differ from the resolution arrived at by his seniors, he should formally disassociate himself from it and document that the disagreement continues to exist. How does the firm meet the requirement of performing an engagement quality control review on its engagements? Non-performance of EQCR has been looked upon by regulators as a serious deficiency of audit quality control by firms. While it may not be feasible for a firm to have an EQCR performed on each and every engagement, every firm must lay down criteria for ensuring that all engagements that carry a level of audit risk should be subjected to the procedure. In most major firms today, it is actually rare that any engagement is signed off without EQCR. An EQCR, put simply, is a cold review of the engagement documentation performed by a professional unconnected with the engagement who has the necessary knowledge and industry experience to be able to perform the EQCR. The loose objective of EQCR is to ensure that the audit work papers are sufficiently well documented to meet the test of an experienced auditor, as mentioned in paragraph 8 of Essay 230. In extremely small sole proprietary firms, where practically the whole firm participates in an engagement, a suitable person may not be available to perform EQCR. Most of such firms have only a few audit clients. Such firms should tie up with a larger firm to outsource EQCRs to personnel from the latter. The reviewer is generally taken on board by the engagement team at the planning stage itself and acts as a consultant to the team whenever required without actually participating in the audit process performed by the engagement team. The reviewer does not have any direct interaction at all with the client, and if he has any queries to be asked, the engagement team obtains the necessary responses from the client and passes them on to the reviewer. Quality controls with regard to EQCR could be: the firm determines criteria for compulsorily subjecting engagements in the EQCR. Only very small and non-risky engagements, considering the size of the firm and the nature of its audit practice, may be excluded. The firm generally designates a senior partner appointed to control, oversee, and monitor the EQCR policies and procedures of the firm. The firm decides on the criteria for selection and appointment of reviewers, ensuring that there is no independence or conflict of interest issue between the reviewer and the engagement to be reviewed, and that the reviewer has the requisite industry knowledge, competence, experience, and seniority in relation to both the engagement and the engagement partner. At the planning stage and subsequently through the audits process, the engagement team discusses significant accounting and auditing matters, all matters on which the engagement team has or is likely to take consultation, and all significant risks identified, as well as the audit procedures by which the engagement team intends to mitigate such risks with the reviewer, who gives his advice, if any. The reviewer does not directly participate in the performance of the engagement at any time. The reviewer confirms with the engagement partner that there are no pending or unresolved issues before starting the review. He examines selected work papers mainly relating to high-risk audit areas, including areas of judgments either made by the client or the engagement team, and determines whether the quality and quantity of evidence examined is sufficient and appropriate to support the conclusions reached. The reviewer examines documentation of how significant accounting, auditing, or financial reporting issues were audited, including consultation documentation. The reviewer reads the summary of corrected and uncorrected misstatements and determines if the extent of audit was adequate in the circumstances. The reviewer reads the financial statements and the draft auditor's report and considers whether the report fairly addresses all the issues concerned and findings made during the audit in keeping with the law, regulations, and professional standards. If there are differences of opinion within the engagement team, the reviewer is the first point of contact for resolving the same. He documents the resolution process and its outcome, and this documentation is kept in the work paper file. If there is a difference of opinion between the engagement partner and the reviewer, the firm has a prescribed mechanism to deal with such situation. Generally, the matter is first referred to the head of EQCR, and then, if need be, it could be referred to the firm's managing partner or to a technical committee comprising of senior audit partners. All such references and their outcome must be documented and kept in the audit files. The reviewer signs off on the EQCR before issuance of the report by the engagement partner. In fact, the firm has a very strict policy of not permitting release of any report unless it is pre-cleared in writing by EQCR. In certain multinational accounting firms, if an engagement partner issues an audit or a test report before formal sign-off by EQCR, strict disciplinary action is taken against that partner, which could even include his dismissal from the firm. We now come to the last of the elements of SQC1, which is monitoring. Why is monitoring a firm's quality control policies and procedures important? How does the monitoring process generally work? These are the two questions. It is a human tendency to not appreciate any form of control. Quality control is no different. Even when people appreciate in theory that quality control is essential, when it comes to following quality controls, they try to find an escape window if it is available. Firms should understand the audit quality is not an option, but it is in their own self-interest that they follow best practices that will prevent lapses in audit and protect them in the event of something going wrong. It is necessary that after establishing and implementing quality controls, a firm's management ensures that the quality controls are followed both in letter and spirit and without favor to anybody. In the larger firms, there is an internal process frequently known as practice review, which is mostly a one-time annual review, but parts of it could be staggered throughout the year. This monitoring mechanism is observed so strictly that even senior partners get tense when it happens. And that is how it should be in order to be effective. The firm's designated quality control partner designs and runs this monitoring review with a degree of independence. The key features of the inspection are: certain partners and senior professionals are selected for conducting the review across the firm. A cross-section of engagements performed during the year is selected. The selection generally is biased in favor of high-risk audits, first-year engagements, significant client engagements, a coverage of all partners, engagements where there have been complaints or allegations that the work has not been performed well, engagements where there have been disagreements between the engagement partner and EQCR. A timetable is determined. Forms and checklists to be used in the review are created or updated. Firm-level quality controls, for example, independence, client acceptance and continuance, human resources, etc., are reviewed by a separate team. Selected files are reviewed by various reviewers to ensure that the firm's audit and documentation policies, accounting and auditing standards, laws and regulations are met by engagement teams. Reviewers examine the documentation to determine if the audit was planned and performed in accordance with the firm's audit manual and whether decisions taken and audit judgments made are supported by sufficient appropriate evidence. A summary inspection report is prepared by the reviewer, giving his recommendations and pointing out if there are any deficiencies. The reviewed files also will be given a rating on a scale. Where there are findings of deficiencies in the firm's practice aids, those deficiencies are slated to be corrected or the practice aid is duly updated. A sample of personnel from all levels of the firm is selected, and these individuals are interviewed to gauge their understanding of the quality controls, how far they have observed them, whether the training programs of the firm are effective, whether they have met their CPE and D requirements, etc. How does the firm deal with instances of quality control deficiencies observed in monitoring? This has to be done at two levels. The engagement level for quality control deficiencies in engagement performance and the firm level for quality control deficiencies in leadership responsibilities for quality, ethical requirements, and client or engagement acceptance and continuance. Engagement-related deficiencies are discussed with the engagement partner and his concurrence is obtained thereto. A summary report is prepared evaluating the overall results of the review and highlighting the common as well as serious deficiencies found and corrective action to be taken. The report may also recommend if any modifications should be made to the firm's policies and procedures. The firm leadership reaches a final decision on the corrective actions as recommended. The results of the review are communicated to all professional personnel to the extent that they are relevant to them. Follow-up is then done to ensure that the corrective actions determined are carried out. How does the firm deal with complaints and allegations? It is in the firm's interest to have in place a system whereby a partner, manager, or member of staff has the ability to raise any concerns that he may have about non-compliance with professional standards, legal or regulatory requirements, or the firm's policies and procedures of quality controls without fear of reprisal. This would include having a whistleblower policy and a sexual harassment helpline. A senior partner who is involved in the engagement is appointed to investigate such complaints or allegations impartially and then to appropriately deal with the findings in consultation with the firm's leadership. He also documents the process and findings. What kind of documentation does the firm prepare and retain to provide evidence of its system of quality controls? The summary monitoring report that is prepared at the end of the entire process of review provides evidence of how the system of quality controls operated. This includes a detailed description of the monitoring procedures it followed, findings, responses to those findings from the engagement teams, evaluation of evidence of the implementation and operational of the firm's quality controls. All of this to establish whether the professional standards and regulatory requirements and the firm's policies and procedures were properly adhered to, whether the quality control system was appropriately designed and implemented, and whether the reports issued by the firm were appropriate in the circumstances. It also evidences deficiencies observed, evaluation of their effects, and the basis for determining whether further action is necessary and what that action should be. The report is retained for a sufficient period of time to meet regulatory requirements. So, The implementation guide to SQC1 contains a sample of the illustrative firm's quality control inspection checklist for a firm. So this again could be followed by firms as per their requirements. So this completes a discussion on SQC1. We now come to the next standard, which is SA 220, Quality Control for an Audit of Financial Statements. The first question is, why are there two quality control standards, SQC1 and SA 220? As discussed in the beginning, while both standards deal with quality control in the auditing space, SQC1 is a quality control at the firm level, whereas SA 220 is quality control at the engagement performance level. Secondly, SQC1 is more broad-based to cover quality controls for firms that perform audits and reviews of financial information and other assurance and related service engagements, whereas SA 220 is limited to quality control procedures for just the audit of financial statements. So SA 220 does not apply to reviews like limited reviews or to financial information other than financial statements like certificates issued by auditors or prospectuses, or to assurance services or other related services like compilation. SA 220 is closely correlated to SQC1, but its focus is not on the responsibilities of the firm's leadership, but on the responsibility of the engagement partner while performing the engagement. Can an engagement partner assume that the firm level controls are effective when he performs an audit? SA 220 assumes that the firm performing an engagement is covered under SQC1, and when it deals with quality controls, it allows the engagement partner to assume that the firm level controls in relation to his engagement are in operation, unless he is informed otherwise. What is the objective of SA 220? The objective of the auditor is to implement quality control procedures at the engagement level that provides the auditor with reasonable assurance that the audit complies with professional standards and regulatory legal requirements, and the auditor's report is appropriate in the circumstances. There is therefore a compliance aspect to the objective, which is easy enough to understand: compliance with accounting, auditing standards, laws, and regulations. And then there is a very loosely worded expectation that the report issued by the auditor is appropriate in the circumstances. The words appropriate in the circumstances say nothing specific and yet say everything. It is a huge expectation of the auditor that encompasses every aspect of what gets covered under a fair presentation financial reporting framework, where an auditor gives a true and fair opinion. For a more detailed understanding of this expectation, one needs to refer to SA 200, the overall objectives of the auditor and the conduct of audit in accordance with standards on auditing. What are the elements of quality control described in SA 220? Similar to SQC1, SA 220 also deals with the same 6 elements: leadership responsibilities, relevant ethical requirements, acceptance and continuance of client relationships and audit engagements, assignment of engagement teams, that is human resources, engagement performance, and monitoring. Who is the leader and what should be his actions and messages emphasize? The engagement partner has the responsibility for the overall quality on each audit engagement. His actions and messages to other members of the engagement team should emphasize that they should perform work complying with professional standards, laws, and regulations, that they should comply with the firm's QC policies and procedures as applicable to the audit, that the engagement team must issue auditors reports that are appropriate in the circumstances, that the engagement team has the ability to raise concerns without fear of reprisal, and that quality is essential in performing audit engagements. What are the engagement partner's responsibilities with regard to ethical requirements? The engagement partner is expected to keep his eyes and ears open and make inquiries where needed to find out if any members of the engagement team have not complied with the 5 ethical requirements of integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. If such an event has occurred, the engagement partner, in consultation with others in the firm, determines the appropriate action to be taken. How does the engagement partner perform his duty with regard to auditor independence on the engagement? The engagement partner must carefully evaluate whether his engagement is in full compliance with the firm's independence policies and procedures. He does so by obtaining clearance from the firms and the network firms independence team that members of his engagement team, including any consultants used, have fulfilled all their independence-related quality control obligations. He makes inquiries to determine if there are any circumstances or relationships that might create threats to independence. If there have been any breaches of independence, he should determine whether those pose any threat to independence for the engagement. He then takes appropriate action to eliminate those threats or to reduce them to an acceptable level by applying safeguards, like eliminating the activity or interest that creates the threat. If even after applying safeguards it is determined that the threats to independence cannot be reduced, then the engagement partner reports such matter to the firm's leadership, and it is decided if the firm may withdraw from the engagement or resolve the matter by taking any other appropriate action. In case of some government entities where an auditor is appointed to audit, the rules may prohibit withdrawal from the engagement after acceptance. In such cases, the only option available to the auditor would be to make a disclosure through a public report of the circumstances that have arisen that would have otherwise led the auditor to withdraw from the engagement. What role does the engagement partner have to play with regard to acceptance and continuance of client relationships and audit engagements? While the firm mechanisms would have checked the appropriateness of accepting a client and engagement, when an engagement partner takes ownership of that client or engagement, it becomes his duty to ensure that the conclusions reached by the firm is appropriate and still valid in the light of changing circumstances. For example, during the course of an audit, one of the things that is normally done is a Google search on the entity, its subsidiaries and associates, its directors, promoters, KMPs, the entity's business practices and litigations against it. Also, new and damaging facts may be discovered during the audit. If the engagement partner obtains any such information that would have caused the firm to decline the engagement, if such information had been available earlier, the engagement partner immediately communicates this to the firm so that the firm and the engagement partner can take the necessary action. What is the kind of information that helps the engagement partner come to his conclusion? As was discussed in SQC1, some of the things that help an engagement partner evaluate the appropriateness of client engagement, acceptance, and continuance are management integrity, including that of promoters, directors, those charged with governance and KMPs, whether the engagement team is competent, both in terms of quality and adequacy of people to perform the audit and has the necessary capabilities, including time and resources, whether the firm and the engagement team can comply with the relevant ethical and independence requirements, significant matters that have arisen during the current or previous audit and their implications on the ongoing audit. In case of some government entities where an auditor is appointed to audit, rules may prohibit withdrawal from the engagement after acceptance. In such cases, again, the engagement gathered may be valuable to the engagement partner in performing and reporting on the audit. For example, the audit partner may revise his assessment and responses to risk. An engagement partner is an important leader who has a role in deciding on the composition of the engagement team. How does he evaluate whether the engagement team on his audit has appropriate competence and capabilities? The engagement team also includes a specialist who has expertise in a selected area of accounting or auditing, such as an IT auditor or a valuation expert, whether employed or engaged by the firm who assists in the engagement team. Some of the factors that the engagement partner considers are the engagement team's understanding of and experience with audit engagements of similar size, nature, and complexity through appropriate training and participation. Understanding of professional standards, laws, and regulations. Technical expertise, including expertise in IT and specialized areas of accounting and auditing, for example, auditing valuation of derivative financial instruments. Knowledge of relevant industries in which the client operates. Ability to apply professional judgment. Understanding of the firm's quality control policies and procedures. What are the various components of engagement performance covered by the standards? The standard covers direction, supervision and performance, reviews, consultation, EQCR, and differences of opinion. What are the expectations of the standard in respect of direction, supervision, and performance at the engagement level? The overall expectation is that the engagement partner takes responsibility for the direction, supervision, and performance of the audit in compliance with professional standards, laws, and regulations, and the auditor's report being appropriate in the circumstances. How does the engagement partner direct his team? He does so by informing the engagement team on matters like their responsibilities, whether they need to be in compliance with ethical requirements and to plan and perform the audit with due professional skepticism, responsibilities of different partners when more than one partner is working on the engagement, the objective of the work to be performed, an understanding of the nature of the entity's business, risk-related issues, problems that may arise, and detailed approach to the performance of the audit. He encourages discussion among the members of the engagement team so that the less experienced members may ask questions and clear their doubts with the more experienced members, promoting team communication. He also encourages teamwork and on-the-job training to uplift the less experienced team members. What are the features of supervision that the engagement partner performs? Supervision includes tracking the progress of the audit continually, considering the competence and capabilities of the engagement team, whether they understand their instructions, whether they are following the audit plan, and whether they have sufficient time to perform the audit. Addressing significant matters as they arise, considering their significance, and modifying the audit plan accordingly, and identifying matters for consultation and consideration by more experienced engagement team members during the audit. What is the responsibility of the engagement partner for performing reviews of the work performed? Work performed by all members of the engagement team requires to be properly reviewed before it can be used for drawing conclusions or an opinion. A lack of proper review is a very serious quality control failure that could be detrimental to the engagement partner and the firm. The final responsibility for reviews, like everything else on the audit, rests with the engagement partner. But on large engagements, it may not be physically possible for the engagement partner to personally review all the work papers. He therefore delegates the role of reviewing routine documents to a number of the more experienced engagement team members. The engagement partner himself reviews important work papers and has discussions with the engagement team in order to satisfy himself that enough work was done and sufficient appropriate audit evidence obtained to support the conclusions reached and the auditor's report to be issued. What does a review involve? It involves that the work performed was in accordance with professional standards, laws, and regulations. Significant matters were raised for further consideration. Appropriate consultation took place and resulting conclusions were documented and implemented. Where there was a need, the nature, timing, and extent of work to be performed was suitably changed. That the work performed supports the conclusions reached and is appropriately documented. That the evidence obtained was sufficient and appropriate to support the auditor's report. And that the objectives of the engagement procedures were achieved. Reviews need to be performed in a timely manner. What this means is, in actual practice, that as soon as the preparer of a work paper completes his allotted area of testing, a review of the document should take place. This is the most efficient way to get the most out of the review process. When a reviewer raises his review notes and returns the document back to the preparer, the matter audited is still fresh in the mind of the preparer, and all client documents, evidences, etc. are still available with him. If a long time elapses between preparation and review, matters tend to get forgotten and lose their importance. Also, if reviews get delayed, there is a risk that at the close of the audit, when the more experienced members of the engagement team are busy looking into disclosures, financial statement analysis, reporting, etc., they may not have the time to do justice to reviewing juniors' work, and reviews may consequently get stepmotherly treatment. Something important could, in such a situation, get missed out. The engagement partner should ideally spend time reviewing critical areas of judgment, especially those relating to difficult or contentious matters identified during the course of the audit, significant risks, and other areas that the engagement partner considers important. Each reviewer, including the engagement partner, must document the extent and timing of his reviews. In other words, he signs off on the work paper. In the event of an inspection by a regulator, if a work paper does not carry the reviewer's sign-off, the implication is that the work paper was not reviewed by anybody. This can have serious repercussions. If there is a change of engagement partner midway through an engagement, the incoming partner should at that stage review the work done up to the date of his takeover and sign off on the extent of work done. When a specialist is used as a member of the engagement team, how is his work reviewed? In large audits, it is necessary to use domain experts as part of the engagement team to perform certain audit procedures. A common example is the use of IT specialists to test internal controls within a client's computer system, or to use valuation specialists to audit the valuation of complex derivative instrument that is recorded in the balance sheet or as a disclosure. The question is whether the engagement partner is responsible for a misstatement in the financial statements that passes because it was given clearance by that domain expert and the engagement partner simply accepted what he was told by him. This is a tricky issue because at the end of the day, it is the engagement partner who is responsible for anything going wrong on the audit. Essay 220 clarifies that when such an expert is used, the direction, supervision, and review of that engagement team members' work may include matters such as agreeing with that member the nature, scope, and objectives of that member's work, and the respective roles of and the nature, timing, and extent of communication between the member and other members of the engagement team, and evaluating the adequacy of that member's work, including the relevance of his findings or conclusions and their consistency with other audit evidence. Why is consultation a strong quality control, and what are the engagement partners' responsibilities for this? As complexity in business methodology, accounting, and technology increases, and as standards, laws, and regulations change rapidly in a fast-moving world, it is difficult for an engagement partner to be a know-all who is competent in everything concerning the audit. For example, new ways of doing business emerge, such as selling products and services online. Complex contracts are entered into that are difficult to understand. New and complex financial instruments are being used where even classifying them into a known slot becomes a challenge. Accounting standards make path-breaking changes in even vital matters such as revenue recognition. Technology used by clients is advancing at a pace that even IT specialists are finding hard to cope with, such as the use of artificial intelligence. Clients are finding innovative ways to pay less taxes, where it may be difficult to determine whether the scheme used is for legitimate tax planning or for fraudulent tax evasion. Changes in laws and regulations bring about newer business risks, which translate into audit risks. Can an engagement partner know it all? Unlikely. Therefore, for matters that he is not an expert on, he would do well to consult with internal and/or external firm specialists. What are the responsibilities of the engagement partner for EQCR? The engagement partner determines if the engagement is covered by EQCR requirements of the firm, determines that the firm has appointed a reviewer to perform an EQCR, discusses significant matters arising during the audit, including those identified during the EQCR, ensures that he does not date the auditor's report on any date before he obtains final written clearance from EQCR. EQCR is a very important quality control, and regulators are very particular about its implementation. While the performance of an EQCR does not reduce an engagement partner's responsibilities, it provides him comfort that a second set of independent and experienced eyes have taken a look at the work done and found nothing wrong. What is the role of an engagement partner vis-à-vis the firm's monitoring of quality controls? An engagement partner is to ensure that his audit work papers are ready for an internal review by the firm. In larger firms, if an audit partner's file ranks low in the internal monitoring process, a very serious view is taken which can affect his career upgradation, the kinds of audits that are allotted to him, and even his compensation. The same also goes for senior members of the engagement team of such audit. Equally importantly, an engagement partner or senior members of the team must carefully read the monitoring committee's reports on previous firm inspections and note the weaknesses pointed out so that they do not repeat the same errors in their audit. What are the key areas that should be documented, among others, by the engagement team in the audit work papers file? There is no upper limit to the amount of documentation that could be done. An engagement team needs to budget a considerable amount of audit time for documentation alone. It is best to document an audit electronically so that certain templates and work papers could be rolled over from one audit to the next and then updated for changes that have taken place instead of rewriting the whole document. However, the rule of the thumb to be used is to ask oneself whether any audited area, the nature and extent of documentation would enable a third party independent reviewer to understand and appreciate how the engagement team met the ethical and independence policies, how the audit was planned and performed, how the risks were identified and addressed, whether any new risks were identified and dealt with, how sensitive areas such as revenue recognition, management override of internal controls, related party transactions, estimates and valuations, forward-looking management judgments, aggressive interpretation of accounting standards, etc., were audited and concluded upon, whether sufficient appropriate audit evidence was obtained for concluding on significant financial statement assertions, whether consultations were properly taken, documented, and its conclusions implemented, and whether the engagement partner, the more experienced members of the engagement team, played their supervisory and review roles that they were expected to perform, whether proper EQCR was carried out and issues raised in EQCR were resolved to the satisfaction of the reviewer, whether care was taken to ensure proper compliance with professional standards, laws, and regulations, and whether the auditor's report truly reflects the audit findings and is appropriate in the circumstances. So this brings us to the end of the presentation today. Any questions?
No, sir.
No? No?
No. I'll just give over. Well, I thank you, sir, for enlightening us on this topic today. As sir rightly highlighted that the quality audit is as important to a small audit firm as much to a large firm. With recent development and changes in the regulatory authorities, we professionals surely need to change our approach and start adopting the quality audit approach in our audit. Sir has very nicely, with suitable examples, highlighted responsibilities expected by the standard and how can we achieve the same. As mentioned by Sir, SQC1 should be properly documented and communicated, which would support the firm in case of any fraud with the auditing. I am sure this would help us and awaken each one of us to adopt quality audit effectively and maintain the trust that is thrust upon to the auditors. With this, I would like to thank our speakers and participants for this session. Thank you so much, sir. There were no questions.